Hello, everyone, and welcome to this short video that is done through the UNISA and e-tutoring partnership. Today, I'm going to be doing this video about the consolidation process. A few things that we would want students to remember. My name is Sajida, and I'm an e-tutor for FAC 3704. The objective of today's short video is to obtain an overall view of what needs to be done when you are attempting a consultation question and the thought process that needs to be followed by yourselves. 3 points that we're going to be talking about. Number one, the importance of frameworks. Number two, the first pro forma journal that you need to know off by heart. It's a standard journal, it doesn't really change. And number three is calculating of the NCI, which is your non controlling interest. It's either in the statement of comprehensive income or statement of financial position. We'll go through both. Importance of framework recognition. This is the first thing you should do when you look at a question and you look at the required. It would ask you for either a statement of financial position, statement of comprehensive income, statement of changes in equity. Once you know what statement you are required to complete, you can start drawing up the skeleton of that required framework. And if we look at this, which is the skeleton of the statement of financial position, it's very, very standard. You always have your headings on the top, which is the name of the company, consolidated statement. Start with your assets, your non current assets. In terms of the line items that follow under that, you can use your trial balance as a guideline of what type of assets and liabilities the skeleton would have because the TV is given to you. So all of assets and liabilities would be shown there, and you can use that almost as a guideline on what to put in. The important thing to remember here, or while you're creating that skeleton, remember that there's possibly going to be additions to your skeleton because we're doing consolidations, and there's a possibility of a goodwill if we bought this company for more than its actually net asset value. So we might have to leave a little line there for goodwill. We would also need to know that under equity, we would be adding a non controlling interest line item because this is a consolidated statement of financial position. We also know that we're going to be removing some things from the skeleton. Investment in subsidiary under your non current assets will have to be removed. It's a consolidation. So remember, it's now looking at it as one company. So we don't have that line item. And if there are any intercompany loan balances as well, these would have to be removed. This is how your skeleton should be looking. Once you've drawn it up with property, plant, and equipment, I've just put these little clouds there for you to remember that you will be adding the amount from the trial balance that is given to you line by line, 100% for certain of these. So, for example, property, plant, and equipment, there's two trial balances being given to you, the parent and the subsidiary. Once you've drawn up your skeleton, you will open up your bracket right here, and you will then put in the actual given information. Do not close the bracket because you don't know what you're going to be reading on in the additional information. But easy marks, given marks, is just to open the bracket and add 100% here. You could leave a line here because we don't know if you're going to have goodwill in your question or is it going to be a gain on bargain purchase. Um, Again, with the trade and other receivables, it's going to be 100%. So open your bracket and include those two amounts that are given on your trial balance. The share capital, this is a consolidation, but only the parent's share capital will be shown. These amounts, if you want, leave it out for now, right? Go down to your, sorry, go down to your non-current liabilities, and then it's 100% of your parent and subsidiary amount. Again, open your bracket, plug in that information, as well as for trade and other payables. These are easy given marks. It also puts you in a frame of mind where you can calm down. Exam situations can be very stressful. So, doing these kind of things that you know will bring down your levels of anxiety and put you into a state of mind where you know what you're doing, and your mind will then read new information and then be able to work on that in a more calm manner. If you're drawing up your profit and loss, or if it was required for you to draw up the statement of profit and loss and other comprehensive income. This is the kind of skeleton that you should have for this. For all amounts here, we go with 100% of the parent and subsidiary. These two figures, we will have to calculate the non-controlling interest, which is what we're going to discuss. And the owner of the parent will then be the balancing figure. So if you have a total here, we will subtract the non-controlling interest and the balance will be there for your parent. If you are doing the skeleton of the consolidated statement of change in equity, in your mind, you need to know how many columns do you have. Standard is your share capital, retained earnings, and your NCI. However, if you had other comprehensive, other kind of income, you might have revaluation surpluses here as a column. So just bear that in mind as well. You will have your balance at the beginning of the year, changes in the equity, which is all the stuff that happened within the year, and then balance at the end of the year as well. Share capital is always 100% of the parent alone. Your retained earnings is your parent's figures plus the percentage of the subsidiary since acquisition. So, at the date of acquisition and then the beginning of the year, that difference is actually in your opening balance, right? Profit, you will find it in your statement of comprehensive income, the parent's portion, right? And your dividend is only 100% of the parent's amount, straight from your TB given information. Here as well, non-controlling interest opening balance is your NCI portion, right? Then your profit as well, you can get it from your statement of comprehensive income, but we'll also discuss that. How do you arrive at that? And the dividend is the NCI's portion of your subsidiary's dividend. So on your TB, you would have dividend of the subsidiary, for example, 5,000, and you know that your NCI is 20%, so 5,000 times your 20% would give you that amount. That's the first thing that we spoke about was all the frameworks. Moving on, we talk about elimination of the at acquisition investment. This is a standard journal, your first pro forma journal. You need to know the format of it, what accounts are debited and what accounts are credited. This does not change. The only line item that is uh, based on the information would be your whether you're going to have goodwill or you're going to have a gain on bargain purchase. But these accounts will always be debited and those accounts will be credited. Right, so we debit your share capital of your subsidiary, you debit the retained earnings of the subsidiary at that date of acquisition, and you credit the investment that you have made as a parent, and you have to credit your non controlling interest. Sometimes that has to be calculated as well, and based on whether you paid more or less, you would have goodwill or gain on bargain purchase, right? Most of this information is found in additional information one. Just looking at one of Unisa's examples, and you can see how the journal looks in this format as well. The only new thing here would be you would have a revaluation surplus. If you had one at acquisition, you would eliminate that as well. You would debit it. The last thing that we would talk about is non-controlling interests, which is your minority interest, right? And how do we calculate the amount? In the statement of comprehensive income, you would calculate your NCI is the profit. Remember, the subsidiary is a company by itself and it has ran the whole year. What portion of that profit is due to the NCI is what we're calculating at this point. So we would go and use the TB and all of the information for the subsidiary to calculate the profit. You would remember you would need to know to eliminate any intercompany transactions that would affect the profit of the subsidiary. This you would have to look through in your additional information. You will calculate the profit of the subsidiary and then multiply it by the percentage interest in the NCI. And this is a little example of that, which is from a UNISA example, where this revenue, this cost of sales, all of these income and expenses was solely for a subsidiary. And they've done a little calculation. They've got to a comprehensive income of 222,513. And they said, right, this is the actual profit for the subsidiary. What portion of this is held by the NCI or is due to the NCI in terms of the profit? We first go and calculate what is the NCI percentage, right? We generally use our capital amount to calculate that. And then we multiply it by 25%. So that is how you would then calculate this figure that goes into the statement of comprehensive income. If we go quickly back, I can show it to you here as well. There it is here, the non-controlling interest, and we would actually be plugging it in here, and the balance would then be due to the parent. In a statement of financial position, how would we calculate our non-controlling interest? This is the balance of the investment at the end of the year. If we did an analysis of owner's equity and AOE, it's very easy to pick this amount up because it's the balance at the end or the total at the end. But if you haven't done an AOE or there's no time to do an AOE, you need to understand how is this figure created. It is the at acquisition amount owned, right? The at acquisition amount, remember we talked about the first pro forma journal, it's going to be found there. We would then add any since acquisition retained earnings, only your NCI portion or percentage, right? That amount is any retained earnings that have built up in the subsidiary from the time we've acquired it, which is probably 2 or 3 years down the line, right till the beginning of the current year. You add that amount in, and then the profit of the current year, which we've already calculated here, is also added, and we will deduct the dividend that is attributable to the NCI. Then we would get our statement of financial position balance. Where would that be plugged in? We would have to plug it in here, and that is where that figure would sit. So there are three things that we've covered in this video, and I hope it's been helpful to you. We've talked about the framework, the skeleton, adding up 100% of information that has been given in your trial balance. Extremely important, easy marks that you could gain, and it also gives you a level of confidence as you start the question, right? So very important to know your framework by heart and know which figures you can add 100% on that on your answer sheet. The second thing that we discussed is your first pro forma journal. It's a journal that doesn't change. It's a standard journal. Know the journal, know which accounts are debited and credited, etc. And those items also, those line items affect your statement of financial position. And the last thing that we've covered today is calculating of the non-controlling interest in the statement of comprehensive income and statement of financial position. I hope this video has helped you, and good luck with the rest of your studies.